While global trade is shrinking and slowdown is visible, and even IMF has cut its estimates of global trade growth to 1.1% in 2019 versus 3.6% growth in 2018. Adani Ports and SEZ, despite this, has managed to grow its overall volumes by 1% over a year ago. Let's do a three-point analysis of Adani Ports Q2 earnings and the outlook going forward. 1. What are the Q2 earnings highlights? Well, in Q2, energy cargo operations, that is coal and crude oil, got hit. Ports like Mundra, Hazira and Dahej, which handled these kind of cargoes, were affected. At Mundra, coal volumes were down by about 24% on a year-on-year basis because of lower imports. Now, similarly, crude oil at Mundra dipped by 30% year-on-year due to lower intake from customers like IOC due to a maintenance shutdown. Now, barring this, the company's performance was good, and by the end of Q2, the company's market share expanded by almost 100 basis points to 22%, including all cargoes. Now, its core port business, which accounts for close to 90% of its overall revenue, was still able to grow its revenue by 4%. That apart, its logistics business made a significant contribution and continuing growth by 77% on a year-on-year basis, helping the company to post overall revenue growth of 8% on a consolidated basis. Now, it also posted a strong 72% year-on-year growth in the net profit. 2. What's the growth outlook going forward? Well, the company's strategy of diversifying the type of cargo and its expansion into strategic locations has really proved helpful. Its performance has, in a downward business cycle, also shown sustainability and predictability of the business model. Now, increasing cash on its books is now being deployed in strengthening and growing its economic moat, which could produce huge benefits in the long term. Now, even after investing about 2,000 crore rupees, the company generated free cash of close to 1,600 crore rupees in the first half of the current financial year. Now, this year it will be undertaking a capex of close to 4,000 crores. Now, this will be used for augmenting capacity at several ports. Now, it is also looking to acquire stake in Concourse Terminals, which is up for privatization. 3. What should investors do now? Well, the company has reduced its growth guidance because of the current market conditions, but even at 8 to 10%, which is the guided growth in FY20, the company is well placed right now. It is now trading at 14.5 times its estimated FY21 earnings, which is near historical lows and also looks quite attractive. Strategic capex, incremental contribution from the new assets and growth from the existing businesses, and the cash on its books are key strengths right now.